A banker picked up the phone. The order was simple. Cancel every pending loan to China. Within hours, $78 billion in global financing vanished, crippling Beijing's access to foreign capital. But Washington missed the deeper risk. Those same loans anchored America's bond markets. And when the financial supports collapse, it's not just rivals that fall. It's the architect itself. Is America's financial war with China already being lost? In April 2025, a single decision sparked a tremor across global markets. Scott Bessent ordered a major international lender to immediately cancel all pending loans to Chinese state-linked companies, according to Bloomberg insiders. On the surface, it was framed as a tactical blow in America's intensifying financial war. But the underlying numbers tell a more fragile story. China still holds $859 billion in U.S. Treasuries. Treasury Department, March 2025. And despite Washington's trade crackdown, Beijing quietly bought $18 billion more in January alone. As U.S. debt surges past $36 trillion and 10-year yields touch 4.5%, Federal Reserve data pulling this lever risks far more than Chinese liquidity. It risks detonating the very bond market propping up America's economy. And if China accelerates its treasury dumping plan, leaked by the South China Morning Post last month, the first casualty won't be Beijing, it'll be Wall Street. But why would Bessent risk a domestic collapse to squeeze China now, unless he knows something the markets don't? When President Trump unveiled his $9 trillion tax reform package in February 2025, Wall Street cheered and then panicked. While the Congressional Budget Office projected an immediate 1.8% GDP boost in 2025, Moody's Analytics warned the move could spike U.S. deficits by $2.3 trillion annually, pushing total federal debt to GDP above 140% by 2028. Already, 30-year mortgage rates have blown past 8.1%, freezing housing markets from Atlanta to Phoenix, according to National Association of Realtors, March 2025. More ominously, Fitch Ratings placed U.S. sovereign debt on negative watch, citing unsustainable fiscal trajectories accelerated by Trump's cuts. Historically, massive tax overhauls, like Reagan's 1981 Economic Recovery Tax Act, sparked short-term growth but ballooned deficits long-term. If history repeats, the administration's bid to fortify the U.S. against China might collapse under its own weight before Beijing ever fires a shot. And the early signs suggest America's rivals are already positioning for that moment. In just the last 60 days, foreign central banks offloaded a staggering $256 billion in U.S. Treasuries, according to Federal Reserve custody holdings, data released April 15th. Japan slashed its holdings by $68 billion, bringing its U.S. debt portfolio to a 12-year low, while Saudi Arabia quietly reduced exposure by $45 billion, according to Reuters. Analysts at Barclays warn that structural buyers of treasuries are disappearing, raising borrowing costs just as Washington unleashes historic deficits. The symbolism is just as brutal. Allies once underwriting U.S. fiscal dominance are now hedging against its unraveling. In a single week last March, the yuan surpassed the dollar as the most used currency for Chinese cross-border transactions, according to PBOC data, signaling a psychological and economic shift. Once global confidence fractures, it rarely mends quickly. America is learning that in real time. And the most dangerous part? Where that fleeing capital is now quietly landing. China, sensing the fractures, wasted no time exploiting them. In the first quarter of 2025, global purchases of Chinese government bonds surged 41% year over year, led by sovereign funds from the Gulf, ASEAN, and even segments of Europe, according to Standard Chartered, April 2025. The People's Bank of China now offers 5.8% yields on 10-year digital yuan bonds, outpacing U.S. Treasuries and with no looming inflation threat attached. Ironically, Washington's strategy to isolate China financially has accelerated Beijing's rise as a credible alternative for global capital. As Fitch's head of emerging markets research, James McCormick, noted last month, China is increasingly seen not just as a trade giant, but as a bond market safe haven in a world awash with American debt risk. If bond flows dictate geopolitical gravity, and historically they do, America may already be losing a quieter, bloodless war. And Beijing's next innovation is even more radical and far harder for Washington to counter. In a strategic twist few foresaw, China's development banks are now issuing Chinese dollar bonds, debt instruments denominated in U.S. dollars but governed entirely under Chinese law, according to a detailed report by the Financial Times, April 2025. Already, over $127 billion worth have been snapped up by Southeast Asia, Gulf states, and even European pension funds seeking dollar exposure without the political entanglements of U.S. Treasury markets. This move brilliantly flips the script. Beijing leverages global dollar demand while weakening Washington's control over dollar liquidity. HSBC's global fixed income strategist Mary-Therese Barton called it a tectonic innovation in a note to investors, predicting that Chinese dollar bonds could erode traditional U.S. debt dominance by 15% within 3 years. If nations can hold dollar assets without holding U.S. debt, Washington's most powerful financial weapon, the world's dependence on treasuries, starts to look less like an asset and more like a liability. And if you think Beijing will stop there, you'll want to hear what they're planning next. While Washington demands decoupling, Beijing is quietly cashing G7 checks. In the first quarter of 2025, European private banks increased financing to Chinese projects by 28%, according to Financial Times analysis, despite Brussels' public support for U.S. sanctions. HSBC, BNP Paribas, and Deutsche Bank collectively underwrote over $43 billion in Chinese infrastructure and green energy bonds, money that's fueling China's next wave of industrial expansion. As Credit Suisse strategist Zoltan Pozsar warned in March 2025, sanctions are a two-edged sword. They may punish, but they also redirect global capital where pressure is weakest. Beijing's Belt and Road Reboot, funded partly with Western cash, now reaches 73 nations, up from 66 just 2 years ago. The irony is brutal. America pressures allies to isolate China, but the pipelines of G7 money are building the very empire Washington fears. And Beijing's next move could weaponize that momentum in ways Washington hasn't even gamed out yet. Inside sources reported by Reuters reveal Scott Bessent is leaning hard on the Asian Development Bank, or ADB, to freeze new lending to Chinese-affiliated projects, aiming to choke Beijing's access to multilateral cash. The ADB, historically cautious, had approved nearly $10 billion in loans to China-linked ventures between 2021 and 2024, often under the radar. Now, Bessent's strategy is clear. If private lenders hesitate, multilaterals must be compelled to starve China's strategic sectors, particularly energy and tech. But ADB's own 2025 governance report highlights a risk. Cutting China off could fracture the institution's funding base itself, as Beijing remains its second largest shareholder after Japan. Financial historian Liaquat Ahmed warned at a Brookings panel in April that weaponizing multilaterals risks eroding their credibility fast. Washington's gamble here isn't just high stakes, it's existential. And Beijing, ever pragmatic, may already have its counterpunch in motion. The real danger isn't just Beijing's immediate response. It's the structural traps it has been laying for years. According to Bloomberg Intelligence, China has finalized new bilateral lending frameworks with Saudi Arabia, Indonesia, and Brazil, totaling over $120 billion outside Western institutions. Simultaneously, Beijing has begun restricting rare earth exports, critical to semiconductors and EV batteries, following the Ministry of Commerce's announcement in March that gallium and germanium licenses would be severely limited for foreign buyers. If loan cuts escalate, retaliation could leap into critical materials, food supply chains, and tech manufacturing. Historian Niall Ferguson warned last month. The West mistook China's patience for passivity. Retaliation won't be loud. It'll be lethal and cumulative. If Bessent's plan backfires, the U.S. won't just face loan defaults. It could face supply shocks across industries overnight. And the clock isn't just ticking, it's accelerating. Some analysts believe America has already crossed the point of no return. Global direct investment into China rose 9.7% year over year in the first quarter of 2025, according to China's Ministry of Commerce, defying U.S. decoupling efforts. While U.S. inbound FDI fell 14% according to BEA data from March 2025. At the same time, the yuan accounted for 5.8% of global SWIFT payments in March, double its share in early 2022. Mohammed El-Arian bluntly told Bloomberg TV this month, "Once a critical mass of global capital moves east, reversing it isn't just difficult, it's structurally impossible. America's bond market remains dominant for now. But history shows reserve currencies don't collapse overnight. They erode, transaction by transaction, bond by bond, decade by decade. If Beijing has built even a semi-credible alternative network, the U.S. may already be fighting gravity. And if you think Besant's lone gambit is the final battle, the next stage is even darker. Because behind closed doors in Beijing, something far more ambitious is taking shape. A fully operational yuan-based global payment system, backed not by promises, but by commodities. Saudi oil, Brazilian soybeans, Indonesian nickel, all priced not in dollars, but in Beijing's new architecture, and if it launches successfully. The financial war won't just reshape trade routes. It could erase America's leverage from global markets. Permanently. We're glad you're enjoying this video. Please like and subscribe. Check out another video that is now on your screen.